Endo Pharmaceuticals said it will pay nearly $3 billion for medical device maker American Medical Systems. That's the company's fifth deal since 2009. Endo's CEO David Holveck joins us along with Bloomberg healthcare reporter Shannon Pettypiece to talk more about this deal.
Well, thanks for joining us, David. I wanted to jump right in and ask you a little bit. This deal is focused on urology. And I think a lot of people think of that as a not really fast-growing area, a very fragmented, very competitive area. So why this big bet on urology?
Well, again, it's driven by growth, and it's driven by the fact that age demographics really, and when you look at older people and quality of life, a lot of it is in the urology or the pelvic area, both male and female. So for us, we think the fragmentation gives an opportunity for consolidation and also gives us an opportunity to better patient care and outcome delivery.
You think, given all the uncertainty around Medicare, Medicaid, health reform, that there's going to be someone willing to pay for these high-tech sort of devices in this urology area? You
know, you're exactly right. I think with looking at healthcare reform, I think there's going to be more interest on both outcome data as well as economics, and I do believe that the government is going to be looking for ways and being able to better serve that patient and serving it through the urology and the minimal invasive technology that can be employed now in the office or ambulatory surgical centers fits well with the model that we're developing, both pharmaceutical and device.
Well, so you've been already moving in urology. This really increases your presence there. Are you going to do more deals in this space? Are there other areas that you want to diversify into as well?
Well, I think we want to stay close to that channel where, again, we're looking at that procedural ambulatory channel. And I do believe that the areas that we want to advance is to be able to bring more interconnection between pharmaceutical device and services. So, again, the economic and the clinical outcome can be achieved. So you'll see further deals that will accent the major building blocks that we put into place, such as device, generics, and branded pharmaceuticals.
Now, this is your biggest deal as a company, from what I understand. Do you see another deal of this size, $3 billion?
This is our biggest, no question. The Qualitas deal, which was a generic one, which we closed last year, was $1.2 billion. So this is a step up from that, but it's a great asset. Their reputation for both innovation and their position with the urologist is just next to none.
But when you say you're still interested in acquisitions, we can't expect another of this size.
I don't think not of this size. I think the major blocks are there. I think the mortar between the blocks are what we want to fill in, and that's what we can go after.
Let me ask you, there was one criticism of the deal today, and worry is the amount of post-deal debt you're taking on here. I've seen estimates of up to $4 billion all inclusive.
Yeah.
Talk to me about that, because S&P has already said they're not necessarily comfortable.
Well, I think, again, we're in an opportunity where critical mass is important for our growth. And I think going forward and looking forward, we have a situation where our legacy business is very profitable. We can pay down that debt. 2013, we'll have a leverage of 2.5, right now about 4. And I also would say to you that, again, now's the time to seize the moment, both with our legacy business to pay down the debt, the cost of money, and, again, the future opportunity of 2014 when healthcare reform kicks in. This is the time to act. Offense, best defense.
Just to follow up on something you said earlier, what size deal would you be looking? Are you talking about a couple $100 million here, $1 billion?
No, I think we're in the couple $100 million or millions, if you would, small millions. Again, it doesn't take much. When you have the pieces that you have, I think a little accent in some of the areas where we can make advancements in diagnostics or in better patient and procedural care with the urologist. Those are all areas that I think accent the major pieces that we have. So nothing big, but I think accent will also spur the growth considerably.
What would those deals look like? Would you move more towards cash? I mean, there's been the criticism that you have a highly leveraged balance sheet now.
Well, I think our highly leveraged balance sheet, but when you look at the legacy business, such as our pharmaceutical branded business, which is growing to double digits, those patent lives take us out to 2015. So from that standpoint, this also being very profitable. Next year, it'll be almost in urology over $1 billion. The generics business, which we picked up, is also growing in double digits. So our ability to pay down the debt is the real feature. And again, now is the time and the cost of money. And again, we have the great assets that we can pull together in this fragmented field and consolidate for the patient.
Having just been out there shopping in the pharmaceutical, I know you looked at oncology, diagnostics. What's the market like out there right now? So very competitive, very fragmented?
It is fragmented, and I think it is competitive, but I don't think anybody has really seized the moment. They're still focused on channels, whether you're a device or a pharmaceutical. I think the integration is what the customer wants. customer perceives value about getting best outcome, and we can deliver that outcome with the integration and the data integration between pharmaceuticals and drugs. Again, the physician looks at that patient for best outcome. They don't look at it as though I treat it with a device or a drug.
All right, David, thank you so much. Shannon, thank you for bringing us this exclusive.